Hi, this is Anil. I was fortunate to be the All India Rank 1 holder in RBI exam back in 2018. Now, I'm absolutely thrilled to be part of Oliveboard as a super mentor for their RBI Grade B programs. If you are aspiring to crack this exam in 2024, I will be available as a super mentor to discuss one-on-one with you, share strategy lessons, draw lessons from my preparation and set you up for success. Click the link below to check out the details. See you on Oliveboard soon.
Hi guys, welcome to Oliveboard. My name is Lakshmi and in this very session we are going to discuss about national income aggregates and related topic. Before moving ahead, I would like to tell you all, if you want the PDF of this very session, you can download the Oliveboard's app, and from the YouTube class PDF section, you can download the class PDF. What are we going to deal in the full chapter? We are going to start with the definition and the concept building of GDP. Once we are thorough with the concept of GDP, then we are going to discuss what are the various parameters involved, like your potential GDP, your green GDP. After that, we'll also read about real GDP, nominal GDP. Lastly, in the session, we'll also have a quick discussion on per capita income. Furthermore, we are going to solve multiple MCQs and also certain practice questions for your descriptive answer writing. Let's move ahead and see what is the definition of national income. If at all you have to define what is national income, how are you going to start it? National income is nothing but the value of all goods and services produced by the normal resident of a country in an accounting period. What is this final goods? Let's quickly understand this by an example. So let's say we have sugarcane. From sugarcane we made sugar, and using this sugar we made a cake. Let's take an example like this. So as far as the things are going, you may say sugarcane is the raw material, sugar is an intermediate good, but your cake is the final good. So that simply means, what are you going to calculate in your national income? You are just going to calculate how much is the amount of cake. What is the monetary value of those cakes that are being produced in the economy? You are certainly not going to consider the value of sugar and the sugar cane in the national income calculation. But let's suppose a customer comes and he doesn't want this cake. He wants sugar. In that case scenario, sugar will no more be an intermediate good. It will be a final good. And for your national income accounting, you will take into account the amount of sugar that is being produced. Now, that simply means a particular product cannot be said as, final or intermediary. It is not that rigid. It depends on what the consumer is asking for. How is the consumer aiming to consume that product? So that is what is your final good. But one thing is clear, final is the key word that you must use when you are defining your national income. Next thing is your accounting period. When I say accounting period, what is accounting period? Accounting period is nothing but the period which you are going to consider while you are trying to calculate what was your national income. So in India, primarily you take into account, your accounting period starts from the month of April and it goes till the month of March. So that means from 1st of April to 31st of March, this is your accounting period as far as India's economy is concerned. Moving ahead, let's first see what are the different types of national income aggregates and why am I saying it that these are national income aggregates. See guys, as I have told you, all the amounts of goods and services produced is your national income. Let's say I have produced 1000 mobile phones, Then I have produced 50 kgs of onions. Apart from this, we have also tried to get 5 kg of tomato. Apart from that, 600 liters of crude oil. Now, can you add this crude oil in liters plus tomato in kgs? Can you just add this? No. Certainly, what we are going to add is the monetary value of all these goods and services. So, when we are going to add only the monetary value which is involved in them, that is where your national income aggregates comes into account. How many aggregates are there? So, all in all, there are 8 aggregates. We will quickly have a discussion on that as well. When I say there are 8 aggregates, let me tell you how are they defined. So, under your first blank come 2 things. That means gross or net. Under second blank comes either your national or domestic. Under this third blank, it is always product. And with these two blanks, either the blank has market price or it has factor cost. And using all these parameters, we are going to define our all 8 aggregates. So, let's begin. Let's begin with gross and net. What is this gross? What is this net? Guys, I hope you all have heard about depreciation. Let's say I bought a car worth rupees 5 lakhs. Now, after 5 years of using that car, I ask you to buy it. And I say I am going to sell to you in roughly 5 lakh only. Will you be buying it? No, certainly. Why? Because the fixed asset that I had in the form of car might have depreciated. That depreciation might be due to some wear and tear which was involved. Certainly, this is what you call as loss of capital, or in economic parlance, it is known as depreciation. One thing we do, one more thing, we are involved in is businesses. What they do is, they know whatever capital, whatever machine they have, it might lose its value and they might have to purchase another machine in some time to come. For that, what they are going to do is, they set aside a part of their capital, a part of their profit, they just set aside it, and that is kept under the head capital consumption allowance. So, this is just extra piece of information. Coming back to the topic of depreciation. Your depreciation is also known by certain other terms like consumption of fixed capital. You might heard these terms many a times in the newspaper. So, whenever you come across a term which is known as consumption of fixed capital, that simply means your fixed capital might have depreciated. Then comes your current replacement cost. Another thing that you can say is replacement of fixed capital. Then capital consumption allowance, CCA. So, these are some of the terms or some of the keywords that we use to describe depreciation in your economic terms. Nevertheless, what is this gross and net, and what is this depreciation related to? Gross is the total amount. Because of depreciation, what we receive is the net amount. That means when I subtract depreciation from gross, I reach to net. Oppositely, when I add depreciation to net, what I get is gross. So, that is how depreciation is related to defining your gross and net. So, when I have to go from gross to net, what I will do is I will subtract your depreciation. So this is nothing but a mathematical equation which you can just see. Net investment is gross investment minus depreciation, as simple as that. So I hope you are now able to understand how is this first blank created, what is the difference between this gross and net. Now let's move upon the second blank, which is national and domestic. Now what is national, what is domestic? Let's have a look at that. Before moving ahead and before describing what is national, what is domestic, let's describe a very important term, that is factor income. See, there are certain factors of production. There are certain factors of production. There are 4 factors of production that you have to remember. Factors are land, labor, capital and entrepreneurship. By using these 4 factors of production, you are able to generate some amount of income. That is known as factor income. Like, when you are using land, you get rent. The hard work that a labor puts in, the effort that he is putting in replacement of that, the labor will get wages, salaries, bonuses. The capital that you are investing in, that capital can be anything. The investment that you have, the capital that you are putting in return of that, you will earn interest. And for the very 4th factor of production, that is entrepreneurship, where you are using your skill, you are taking risk. In return of that, you will get profit. So, for every factor of production that you are using, you generate a certain factor income. That's how you can see rent, wages, interest and your profit. So this is your factor income. Let's see what is the definition of factor income. So factor income refers to the incomes which is derived by those who provide factor services. So these were the 4 factors services, and subsequently you generated some amount of income. That simply means this is a type of bilateral payment. In this type of method, there were certain goods and services produced, and in return of which you got an amount of income. The income was generated. That's how you can describe it. One more term that you might come across is your transfer income. Have you guys heard about gifts? Have you guys heard about remittances? Your, let's say, widow pension, scholarship, for all these things, for getting this scholarship, have you produced any goods and services? No. You might get a service, a scholarship based on some merit, but definitely you have not produced anything extra. Similar is the case with widow pension. When I say widow pension, there was nothing that was, there was no service rendered in replacement of that. Same is the case with remittances. Your elder brother, your parents might be sending you some amount of income from abroad. Some gift can be sent. Again, there was nothing that was done for that. No goods and services were being produced. This type of thing is categorized under your transfer income. So transfer income is a unilateral payment. So factor payment and your transfer income, these are somewhat complete opposite of each other. And if you guys remember, when I was telling you about national income calculation, I told you, you have to add only all the goods and services that were produced. But as in your transfer income, for your transfer payments, there is no good and services that is involved. No goods and services are being produced. Therefore, transfer income are not included in your national income calculation. that you have to be clear of. Now just one more question that is coming to my mind is regarding retirement pension. When I say retirement pension, what do you think about retirement pension? Is it a transfer income or a factor income? Definitely, retirement pension is not a transfer income. Why? Since it's a pension and major pensions were being classified under your transfer income, then why I am saying your retirement pension is not a transfer income? Why? Because the money that you were generating, the pension that you are getting now, was either was your contribution that you made while you were in service. Since you have already given the service, you have rendered the service, therefore retirement pension is classified as your factor income. Please be clear with this. I hope that's clear to you all. Next thing. Up till now, we have seen what is factor income, then we saw a complete opposite, transfer income. After factor income, transfer income, let's see what is this net factor income from abroad, because that is where we can define what is national and what is domestic. So guys, see, national versus domestic. When I say national, I talk about Indian nationals, taking the example of India only. What is the income of Indians? Either they are living in India or they might be living in abroad. When I say national, I am just talking about the Indians that are there. The income that is generated by Indian nationals. That is what I am going to consider when I am talking about national. When I say domestic, domestic is used for territorial purposes. That means whatever goods and services a country is producing within its territorial borders, that can be in its island, like your Andaman, like your Lakshmi, also military enclaves, also embassies which might be located outside. So these are nothing but Indian domestic territory, and whatever goods and services that are produced in this very territory, in this very region, we'll say these goods and services will be calculated under your domestic head. These goods and services might be produced by Indians or foreigners who are living in India and producing those stuff. So that's how you can differentiate between national and domestic. I hope that's clear to you all. And when I am going to calculate domestic, what I have to add, or if I am going to calculate your national, what I have to add if what I am given is your domestic. In that case scenario, if I know domestic income, but I have to calculate national income, what I am going to do is, I am going to subtract from this domestic, I am going to subtract what foreign earnings are there, whatever foreigners are earning. Because in this domestic territory, whatever foreigners are earning, that is also there. But in national, I want only Indian nationals. So what I'll do is, I'll subtract foreigners' earnings, but I'll add Indians' earnings from abroad. So whatever Indians are earning, maybe sitting in US or UK or whatever foreign territory, if whatever they are earning, I'm going to add that. And subtracting foreigners' earnings and adding Indian earnings from abroad, in your domestic thing, I'll get to a value which is your national income. So that is how I'm going to describe the second blank, that is your national and domestic. That simply means your national is equal to domestic plus net factor income from abroad. This net factor income from abroad is nothing but factor income earned by abroad by Indians minus factor income paid to abroad, because this income was earned by foreigners in India. When they are going out, we are going to subtract it, and that's how we are going to get your national income. I hope that was clear to you all. That is how we have defined the second blank as well. As the third blank is only product, so that is not going to change. Moving ahead, let's see what is this market price and what is this factor cost. See guys, whatever price I am paying for a particular product, let's suppose I went to the market, I purchased a packet of Parle-G. That Parle-G might have costed rupees 10. The MRP might have been rupees 10. So 10 rupees is the market price, the price at which I have bought that product. Certainly, MRP or the market price comprises of your taxes. But do you think in manufacturing that Parle-G, the cost of land, labor, capital or entrepreneurship would be the same? No, definitely it could have been different. Why? Because in your factor income, factor payment or whatever you want to say, in your factor cost, it comprises of land, labor, capital and your entrepreneurship. So when I am just taking into account these 4 factors, that is where your factor cost comes into play. That means when I am given this factor cost and I want to calculate this market price, what I am going to do is I am going to add net indirect taxes. And if I am given this market price and I have to calculate factor cost, what am I going to do is I am going to subtract your net indirect taxes. Now, if I have to define this net indirect taxes, what I am going to do is net indirect taxes is nothing but the taxes that you are paying minus the subsidy that the government is giving. So your market price is nothing but factor cost plus taxes minus subsidy. That is also what you can write. So market price is nothing but your factor cost plus taxes minus subsidies, and this taxes minus subsidies is also known as net indirect taxes. So that's how you will define the third blank. Now let's see what are the 8 aggregates. Since we have developed all the blank positions that are here, let's see what are the 8 aggregates. So what we are going to do is we are going to take one word from each blank. Let's see how. One can be GDP, gross domestic product at market price. Then it can be gross domestic product at factor cost. Then it can be gross national product at market price, or it can be gross national product at factor cost. Then it can be net domestic product at market price or net domestic product at factor cost. Lastly, it can be net national product at market price and net national product at factor cost. So these are the 8 aggregators. I hope that's clear to you all. Now I hope you are able to understand what is the difference between GDP MP and NDP MP. Now let's suppose I give you this question where I am asking you GDP MP. How will you calculate GDP MP given I have given you NDP MP? I am asking you how will you calculate that? Simply you can see market price is same, domestic, here also domestic. So just one parameter that you have to change is from net you have to go to gross. Certainly what you are going to do is you will add depreciation. That is how you are going to find it out. Now let's say, making the things a little more tougher, I am asking you to calculate GDP MP, again gross domestic product at market price, but in this very time I have given you NNP at market price. So again, now I have changed two blanks, that is from net to gross. That means simply you will add depreciation. I have also changed national, but you have to go to domestic. From national, if you are going to domestic, what are you going to do is you are going to subtract net factor income from abroad. So you will reach on a number that is GDP at market price. Taking the things forward, let's suppose now again I am going to ask you what is GDP at market price. What have I given you is NNP at factor cost. Now I have changed each of the variables. So from net to gross, you are going to add depreciation. From national to domestic, you are going to subtract net factor income from abroad. For factor cost to market price, I am going from factor cost to market price, I am going to add net indirect taxes, or I am going to add taxes and I am going to subtract your subsidies. So this is how you can go from one aggregate to another. I hope that's clear to you all. Now let's try to define national income again. So national income, it is a measure of sum of all factor incomes earned by the citizen of a country for their land, labor, capital and entrepreneurial talent, whether within the country or abroad. Because in national income, the word is national, that is the income that is earned by your Indian nationals. It is equal to NNP at factor cost. So in one word, if I want you to remember, whenever somebody is asking you what is national income, it is nothing but your NNP at factor cost. That is net national product at factor cost. It is obtained, I hope you know by now that it is obtained by deducting your net indirect taxes from NNP at market price. So what you are going to do is you are going to add NNP at market price. For the prevalent market prices, you are just going to calculate the data and then you are going to subtract the net indirect taxes, and after deduction you will be getting NNP at FC. That is how you are going to get what is national income. Next thing is, what is domestic income? See guys, in national income, I was concerned about Indian nationals. In domestic income, my thing or what I am going to consider is my domestic territory, whatever Indians are earning in their own domestic territory. That territory can also be a ship of India, which is roaming around in some open seas. That can also be an airplane of India, which might be in US, or in that airplane there might be some goodies which are being given, or some other goods and services might have been exchanged. So in that case, even if the ship is of India, the airplane is of India, that is our domestic territory, and that's how we are going to take into account that as well in the domestic income. So in your national income, when it was your NNP FC, in your domestic income it will be your NDP at factor cost. So that's how we are going to calculate your national income as well as your domestic income. I hope that's clear to you all. Moving ahead, let's look into this. What is potential GDP then? You might have heard India has this much potential. Indians have a potential to do this, or we are lagging behind in what we could have achieved. So our potential was that much, but we are not able to achieve it. Before moving that, let's try to describe or define what is potential GDP. So potential GDP is referred to the highest level of output. How highest level of output? That output means any goods and services that are to be produced or an economy can produce without inflation. The potential GDP is often used as a benchmark to gauge what is the actual level of output in an economy and to what measure the economy is operating. Because potential can be higher, but your actual GDP could be lower. So that can also be a case. So there are certain determinants of your potential GDP. There are certain ways in which you try to describe your GDP. So potential GDP have certain determinants like your employment. What is the employment rate in the country? What is the labor force participation rate, LFPR? What is the technological use? How much technological penetration is within the country? In each of the sectors, it might be hygiene, health, it might be education, or other sectors as well. Sustainability. What amount of natural resources they are using? What is the optimal resource utilization in the economy? So if we are adding that, then also that is also one of the determinant. What amount of pollution is there? What is the negative externalities that are being there because of excess pollution that is being created? So we have to take into account that also when we are trying to calculate potential GDP. Then regulatory framework. What is the amount of regulation that is there in the economy? Is the economy open? Like India has opened its economy in the after the year 1991. So what is the level of openness? What is the level of competition within the economy? What is the level of or the quality of goods or services that are being produced in the economy? That is also one of the determinant of potential GDP. Lastly, currency volatility is also a very important factor. If your currency is volatile, too much volatile, the investment will be very less because there will be a lot of skepticism for the investors when they are putting money. They will be reluctant. These are some of the determinants when we are trying to calculate your potential GDP. Now, if somebody asks you, why is India not able to achieve the potential GDP? Why our actual GDP remains a little short of our potential GDP? So certain factors that you can add over here are low productivity. The level of productivity is lower in India. That can be said in the terms of agricultural output. As you all know, India has a large amount of arable land. But despite of that, our productivity levels are low. Why? Low level of agricultural technology that we are using. Agriculture is more or less, research deficient in India. We are not able to have a lot of research and development in our agrarian sector. Reason? Private sector is not pulling, or you can say private sector is not investing in agricultural sector. Agriculture sector in your specifically for research and innovation, the major amounts of fund that is going in this is by government only. And government has financial restraint. Government cannot put money, before more than a certain limit, and that's why low productivity in our agriculture sector. Same is the case with our hospitality segment. Same is the case with our manufacturing unit, and that's also a reason why there is lot amount of unemployment in India. Because in India, we are majorly focused on service sector, which is not labor intensive. So again a problem why India is not able to achieve the full potential of its GDP. Next thing is the currency depreciation. In comparison to the harder currencies like your dollar, rupee is not that much strengthened. Though in the last couple of years, we have actually tried to internationalize our currency, but yes, there are certain problems as of now, and because of that, Indian rupee is somewhat volatile. Though sometimes RBI tries to intervene and do certain kind of operations to stabilize our currency. Either it can be via sterlization or OMOs, open market operations. But still, there is some amount of volatility when it comes to our value of currency. Next is when the currency is not stable or it is not stable to that mark, the foreign direct investment, the FDI that is coming to India remains a little low. Though India received a good amount of FDI in last couple of years, but still we could have got more. Looking at the market, the vast market in India, we could have achieved a lot, but we are not able to. Reason? Currency volatility, the amount of regulations, regulatory framework that is in India. Little bit businesses are reluctant to open their enterprise in India. Lastly, one more thing that you can add on to this is lack of infrastructure. So India lacks certain amount of infrastructure. Primarily, if I talk about the infrastructure that is related to your social segment or the business infrastructure, the ecosystem, that is lacking, and that is also hindering our potential to achieve the highest amount of GDP that we are capable of. Moving ahead, when we have talked about GDP, all its aggregates, now let's delve into a very important thing, that is the revision that happened in the national income accounting. What was this revision all about? Let's have a look. So the national income accounting was revised the way it was done up till now. In January 2015, the revision was done. If I tell you about this revision, then in this revision, there were 4 changes that were made. So the first change that was made was base year revision. Earlier, the base year was 2004-05, then it was changed to 2011-12. After that, the economic growth rate, the way we were calculating our economic growth, the methodology was tweaked a little bit. So what was the change? The change was, earlier we were using GDP, that is gross domestic product, at factor cost. But now what we are going to calculate is at market price. I'll tell you about what is this constant in a bit of time, but till then GDP at factor cost was what we were considering earlier, but now we are calculating GDP at market price. Factor cost means we are not taking into account taxes. Net indirect taxes are not there. But when I am talking about market price, I am genuinely considering your net indirect taxes. Matlab taxes are being added in these GDP MP calculation. Next thing that was done was for sector-wise growth rate estimation. If we are talking about some specific sectors, that can be your automobile sector, that can be your hospitality sector, your tourism sector, or whatever sector you are looking into. For sector specific calculation, we actually headed towards gross value addition at basic prices. BP stands for basic prices. Now what are these basic prices? Basic prices are nothing but your factor cost plus production taxes minus production subsidy. Now what are these production taxes and these production subsidies? So production taxes and your production subsidies are the taxes or the subsidies likewise which are levied or received with relation to the production independent of the volume of the product or the goods that is being produced. So that means production taxes and subsidies, it does not depend on the amount of goods and services that are produced, not the volume. You have to give certain amount of taxes like your stamp duty, the subsidies that is given to the farmers, like under PM Kisan, government is giving 6,000 rupees. No matter if the farmer is rich, poor, he's a small land, he has a small land, a larger land, no matter what is the size of the land, the subsidy is given irrespective of that. Certainly, these type of subsidies are being categorized under your production subsidy because that is not in relation to the volume of goods and services being produced. On the contrary, when I say product taxes and product subsidies, that is in relation to the goods and services produced. I hope that's clear to you all. So that means the subsidy that the farmers get on fertilizer, that is product based subsidy. But when I am talking about basic prices, GVA at basic prices, for basic prices calculation, what I am going to do is at factor cost, I will add production tax and I will subtract production subsidy. This you can call it as net production taxes. So what I am going to do is for basic prices calculation, I am going to add in factor cost, I am going to add net production taxes. I hope that's clear to you all. So this was the change, the third change that was made. Lastly, the fourth change that we made was, we elaborated the source of data. The sources of data from where the data was being collected was enhanced. Various regulatory bodies like your RBI, SEBI, they were being asked to show their data, to tell whatever data they have to the MOSPI, because MOSPI is the one who calculates your national income. So the ministry collected data from various regulatory bodies. Local data was also taken into account. MCA 21, which is an e-governance initiative of Ministry of Corporate Affairs, was also being asked, Ministry of Corporate Affairs was being asked to tell all the data that it has. So that means they wanted to engage the vast amount of data that is there in the with these bodies. Now, when such a major change was done, there might be some thinking behind it. Why at all we are changing this? We were changing this, one thing, because this was an international practice that is being followed by your World Bank as well as your IMF. Be it your World Bank, be it your IMF and other developed nations, they follow such practices. That is the practice of calculating GDP at market prices. Though earlier we were using factor cost, but these people were using market prices. So that's why we also changed it, because for international comparison, this calculation will make it easier. So that's why the change was being done. The other thing was, GVA calculated at basic prices showed a better picture of the things that were going around in the market. The collection of data from so many sources actually government was trying to check what are the errors that are involved. Next thing. But there were certain issues that were being raised by the critics. What is that? So I hope you all remember, I just told you that in 2015, we brought this new change. When we tried to calculate the GDP of 2013-14, the GDP, when it was calculated with the same method for 2013-14, at factor cost, when the GDP was coming out to be 4.5% something, at the same time, when we started to calculate the same GDP using the new methodology, the GDP got inflated to roughly around 6.7, 6.9%. And if I have to describe this 2013 era, then in this 2013, there were certain problems in Indian economy. What were the problems? The problem was, the savings in the economy got reduced. The investment in the economy was low. There was foreign capital outflow. Foreign capital was moving out of India. When foreign capital moves out of India, I hope you all know that rupee depreciates. And when rupee depreciates, there is a problem in the economy. So that these were certain things that were happening. And then this was not being shown with the new GDP calculation. But in fact, the GDP which was calculated was coming to be on the higher end. So certainly this was one of the issue, but if I have to sum it up, the government said it very rightly that because World Bank, IMF, other economic bodies, even the developed nations are calculating GDP with the same formula, we should also do it likewise, because this will help in better comparison. So that was all regarding your revision in the national income accounting. And from the next session, we are going to take this forward. We are going to see what is green GDP. After that, we are also going to look what is per capita income. That's all from my side for this very session. Thank you and have a nice day.
The journey to crack one of India's toughest exams, the RBI Grade B, is long one that needs perseverance and the right strategy. Hi, this is Anil. I was fortunate to be the All India Rank 1 holder in RBI exam back in 2018. If you are aiming to crack this exam in 2024, I might be able to help you achieve this dream. As a super mentor for the RBI program on Oliveboard, I am available to interact one-on-one with you, share strategy lessons and draw insights from my own preparation and set you up for success. Click the link below to check out the details. See you on Oliveboard soon.